So I'm going to ask you some common questions that I get asked all the time. I'm sure in your journey also you get asked almost on a daily basis, right? So people ask me, Sonia, should I buy now? What is the risk in the market? How much will I lose? How much will I gain over the next 10 years? So time, volatility, risk are a couple of key issues that people have.
Yeah.
What would your advice be to them?
Yeah, no, so we got this question a lot as fund managers, obviously. We get this all the time. We go to presentations and, for everything that we discuss, these questions always come up. They're fairly consistent. Is this the right time to invest? What returns can I expect? How much can I lose? It comes in different forms, but essentially these three questions. So like you correctly mentioned, so there are three elements. Time, is this the right time? So time. What returns can I expect? So returns. And how much can I lose? We measure in something called volatility, which is the up and down of the market. So we heard it so many times that we said, let's plot this and give a actual mathematical answer rather than a very in the air answer. So we took time first, just imagine an x-axis with time, and time as measured by rolling periods of time. What are rolling periods of time? So let's say we can take rolling periods of 1 year, 3 year, 5 year, 7 year, 10 years. So for example, a 10-year rolling period is that if I bought the market anytime, on any given day in the last 30 years, what returns did I make if I held it for 10 years from that day? So literally for every day, we will measure 10-year returns. And then the median of all those 10-year returns is what we will plot into that graph. So we took 1 year, 3 year, 5 year, 7 year, 10-year rolling periods. And what we observed was the returns, irrespective of when you actually dropped into the market for 1 year, 3 year, 5 years, 7 year, 10 years, ended up being in that 13 to 15% range. Okay?
Rolling returns.
Rolling returns. So the median experience of investing in equities is 13 to 15%. Volatility, on the other hand, is a very different picture. 1 year volatility, so that's the variation in the market, is as high as 30%. The 1 year average rolling volatility was 30%. Now that tells you something straight up front. When you're buying something, you want the return to be higher than the risk you're taking.
Absolutely.
Right? Why would you buy equities with a 15% upside for 1 year with 30% volatility? Right? It's like a 2:1 ratio against you. So effectively what it started telling us that 1 year, you're actually just buying the volatility. You're not even buying the returns if you take a 1 year view on markets. It's a matter of luck. You just got in at the right time or got in at the wrong time. You're good luck or bad luck.
It's pretty much like marriage, right? Like the first 1 year in a marriage, 1-2 years, is like a roller coaster ride. You don't know, you're adjusting to a new place. There's like so much volatility. And then is when the kind of compounding begins.
Yeah, but hopefully you do enough research before marriage. But you're right. So volatility in the first few years is actually much higher than the return. So the volatility graph, so the return graph is very steady through time. The volatility graph is really high, but as you give it time, it starts falling quite significantly. Now logically, as I said, your return should be higher than your risk. So over what period does mathematically the return become higher than the risk? Does the volatility graph fall below the return graph? And that is at a 5-year point historically in India. So 5 years and above, your returns have always been higher than the risk that you're effectively taking. For mutual fund companies in India, most of whom have created alpha, that cutoff tends to happen around the 4.5-year point. And interestingly, actually, if you go back and look at most mutual funds, most of them will have a track record of not having delivered negative returns in any 5-year period. At least we had that track record in DSP. We never had a 5-year period of negative returns. So essentially, what it tells you, therefore, is that 5-year investing produces a higher return for the amount of risk that you're taking. As you shorten your duration, 1 year, 2 years, you're buying the volatility, not the underlying market returns. So that's an interesting way to sort of think about it.